Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He says they're finally rolling over, and if they don't return to their record highs, it could be sign of trouble ahead. Ross takes a look at the rising oil sector, along with the U.S. and Canadian dollars, Bitcoin, and gold and silver. InsideTrackTrading.com President Eric Hadik takes a close look at where we are in the cycles that affect gold, silver, platinum, palladium, the U.S. dollar, Bitcoin, crude, natural gas, and lithium. He also tells us if this will be a sell in May, go away year. Author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, comments on the state of Canadian real estate. He hints the bubble he wrote about might just be ready to blow up. He also talks about tariffs, money laundering, and the electric vehicle market. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be back, Jim, and a very interesting week.
How would you describe what happened on the stock markets?
Well, the stock market finally rolled over. You know, we've been looking at this since November. Various indices were having trouble. We got a series of Hindenburg signals. That's where we have a very disjointed advanced decline line with a number of the indices just not doing well. So now we've got everything not doing well. And the volatility index, VIX, is up to 27, which is high, but not an extreme. But what's important here is that when we count the number of weeks that it has been moving, it's 9 weeks now, creating a sequential pattern. That is very rare. We've got that maybe 10 times since 2000. And by the time we get that sequential 9 count on the VIX, you know that you're approaching a point of panic, and so we would be looking for an interim low pretty darn soon. And on the S&P, I'm getting a sequential or a springboard signal, which is a good oversold signal on the weekly chart. Haven't had one of those since back in the bottom in April. So big oversold reading there. And on the daily charts, getting some good readings on the S&P as well. So looks as though we're going to be looking at an interim low probably within the next week or 10 days. The key will be how well it bounces. And so the 20 and 50-day moving averages on the S&P need to be watched very carefully. If the bounce is incapable of taking out that 50-day, then the next leg to the downside will probably be a lot harder than the one we're in right now.
What's going on with crude? Pretty exciting?
Well, now we're doing a bit of backing and filling finally after that, run that we had to 120 and then back to 80. So this week we close at 98.70, and that's what you would call a bounce. We've got basically a $20 bounce. This thing is all subject to politics and, what's the reactions on the Iranian war. So, who wants to, toss their coin here to figure out where it's going? The fact is that it is influencing a lot of markets, without a doubt. The stock market is one. You take a look at the agricultural markets there. You've had wheat, corn, and soybeans all have pretty decent rallies here because, whatever goes through the Strait of Hormuz is going to affect other, various products, including the fertilizers. So, there we are for the grains having a pretty good run. And at this point, the oils, which had been, very favorable just on a seasonal basis, are now doing exceptionally well. If you take a look at the Canadian oil stocks there, they're running. The XEG, which is the index, is at just at multi-week highs. And on the U.S. side, the XLE. So that's the big names like Chevron doing exceptionally well. And, that was on the coattails of what happened in Venezuela. So there's a lot of stuff going on here. The U.S. dollar had its best week in months and closed at the best level we've had since April, May. And that's not unsuspected. We were looking for a good bottoming pattern here. And clearly, it's, it was the double bottom July through the first part of this year. And if anything, it might be just a little ahead of itself right now. But the dollar index at 100 is up, considerably from the 96 level that it was back in January. The one currency, actually, if you take a look in the currency basket, the euro and others have been doing poorly. And if you take a look at the Canadian dollar, there you've had us have a little bit of a bounce a week ago. Maybe that was off of oil, but we're back down to 73. So that's the lowest level in about 3 weeks. And, when you've had a good move in oil and a good move in the agricultural commodities, the poor action in the Canadian dollar here is then representative of something that's got further to go on the downside.
What's going on with gold and silver?
We're doing some backing and filling here, and as of this week, we had been looking at this consolidation to run for, anywhere from, many, many weeks. And as of Friday, gold and silver generated oversold springboard signals for us. So that's a mild signal within a dominant uptrend. They both have had a pause since that big exhaustion high at the end of January and that hard correction. But this consolidation now can be setting up for a pretty decent base and a move to back to retest the highs. So look for some good upside action if they can take out the first level of resistance above us now, because the oversold level is the type of thing that we saw back in May through August 3 times. We saw good springboard signals in there, and as we know, things really came to life at the end of August.
What's going on with copper?
Copper market not doing as well as the precious metals, just biting itself around 575 at the end of the week. We've been at this trading range now since the end of December, so other than one spike up, there's not too much going on in that copper market. The underlying trend is up, as it has been since July, so don't be surprised if it does come to life again.
what's going on with Bitcoin?
Bitcoin closing around 71,000 at the end of the week. We had that big exhaustion point on the downside in the beginning of February, and then a retest lows in March. That was the setup for a base, actually a very similar one to which the U.S. dollar did. And it looks as though now that base is capable of pushing us higher. I would think might be up around 80,000 is the potential. So, for traders from 71,000 to 80,000 is a pretty good trade.
Ross, anything else we should be keeping a close eye on right now?
The other one of note would be the T-bonds, Treasury bonds, and yields are hitting some extremes that we can see for on the short term. The bond market was up around 119, sold off now to 113.5. Good oversold signals there. So for anybody looking at the bonds, I would suggest that there's a good trade here, probably back into the mid 116 level. And for bond traders, that would be a nice move.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Yeah, thanks for having me back, Jim. Great to be here.
Can you tell us a bit about your newsletter, Inside Track, spelled with two I's, and how our listeners can subscribe?
Yes, Inside Track is a technical and cyclical analysis-based research and analysis publication. We have both a weekly and interweek publication and a monthly and intra-month publication that really focus on most of the financial sectors and financial markets and the commodity markets as well. And readers or listeners can find out a lot more at our website, InsideTrackTrading.com. That's spelled with the extra I in the middle, so it's INSIIDE TrackTrading.com.
Last month, silver hit new all-time highs over $121 an ounce. Is silver likely to retest that high?
I've got a couple of indicators that I'm really focused on to help clarify that for me. And so far, it has maintained positive structure and not signaled a full multi-month reversal down. So the odds continue to favor a retest of that high. And all along, I had been looking at two key time frames in 2026 for a pair of highs in the precious metals markets, and they were in late January and late April, early May. Almost all of them peaked right along with that late January time frame, and I would expect the next top to come in late April, early May.
Last month, gold hit new all-time highs over $5,600 an ounce. Is the gold cycle likely to retest those highs?
Yes, I think that gold it actually has a much better chance of rallying to higher highs. And one of the things I was just writing in one of my intra-week alerts yesterday was just a reiteration of what I continue to contend and what I often get questions about or critiques about, and that is that the idea that gold moves along with geopolitical upheaval or that gold moves along with inflation, I think are both very misleading, very disingenuous, that for any period of time, any extended period of time, and on any consistent basis, you rarely see that correlation in gold. And a much closer correlation has to do with interest rates and, more importantly, expectations for interest rates. And when the market is anticipating steady to lower interest rates, then that's very positive for gold. When the market starts to anticipate rising interest rates, that is a real burden on gold. And that's what we've continued to see. And funny enough, but not surprisingly, my work in bonds and notes and inversely in interest rates has been telling me to look at April, May of this year as the ideal time for a peak in bonds and a low in interest rates. And that doesn't mean that bonds go straight up into there, doesn't mean interest rates come straight down or consistently down into there. It just simply means that that's where the peak in bonds and the low in interest rates is most likely. And that could be something that all occurs within a few days, or it could be something that's led into gradually. You can go back over different extremes in markets like that. And sometimes the whole spike high is just a few day period and a few day event where maybe the stock market's taking a big hit. Maybe there's some other thing that gives a little bit of a rush in or a safe haven play. And so you'll see bonds spike up and corresponding interest rates spike down. So just to be clear on that, again, doesn't mean that I think rates are going steadily down into then, but I think that that's when we could see a peak in bonds. And if that's accurate, that would play along with cycles in gold and silver and the white metals that come into play in late April, early May too. So if there is some maybe a few weeks of a perception that rates should head lower, then we could see gold, silver, platinum, palladium heading back towards their highs leading into late April, early May.
Last month, new all-time highs for platinum, over $2,800 an ounce, palladium over $2,100. The white metals pulled back and have since been trading sideways. Where do you see the white metals going from here?
Very similar to gold and silver, although there are certainly times when fundamental factors will impact one more than the other or isolate one from the others. But I still see them as being in a constructive technical pattern when all of the metals, gold, silver, platinum, and palladium, when they had those sharp corrections from the late January peaks, they all did pretty much the same thing, technically speaking, and that had to do with their weekly trend that they neutralized. The trend indicator that I use that's a little bit of a lagging indicator or confirming indicator, it has to turn neutral from up or down. So up to neutral, down to neutral before it can completely reverse. So there is a kind of a limbo period or a transition period in there that a market has to go through for this very reason. You saw those sharp corrections in all the metals. They neutralized the weekly trend, but they would not turn it down until specific weekly close prices that I've elaborated in my weekly relay publication. And until those markets trigger those signals, then they remain in an up or up neutral weekly trend, and that gives the benefit of the doubt to them heading higher into the next cycle time frame and ideally retesting or exceeding their previous highs. Platinum and palladium in particular has acted a little weaker than the others. So there's also that possibility that a late April, early May peak could have some divergence where gold and maybe silver set new highs, and platinum palladium might set double tops or lower highs. You could see that type of divergence if that's what we're setting up for here.
The Dow has pulled back from new all-time highs. What are your cycles predicting for the Dow?
My work has been showing the same thing in all the stock indexes, even though they peak and signal reversals at a little bit different time frame. But I started talking about it with the NASDAQ 100 back in late October when it fulfilled a myriad of cycle progressions and told me that a multi-month top was taking hold there. But the broader market and a lot of the indexes were all showing that January, February 2026 should be when we see a significant peak. And so far they have adhered to that. I was discussing back in February how the Dow was fulfilling a lot of upside potential, both in price and timing. And then on the 11th and 12th, the Dow, the S&P triggered sell signals. And my work showed at that time that we should see an initial drop into the time frame where we are right now, March 11th, 12th, 13th, and that they could reach some pretty extreme downside targets, a couple of which that have been hit, particularly in the S&P 500. But I've got some additional downside objectives in the Dow, and I've detailed the next set of cycle lows that I expect coming out a few weeks from now. So I could still see the Dow work lower into that specific time frame and even down to the price levels that I've published.
Dow Jones transports have pulled back in March after hitting new all-time highs in February. Where are the transports in their cycle?
Really all of the equity indexes, because this is a broader topping phase that I expect, they are all in similar phases of reversing to the downside and setting what I believe was a multi-month peak, could even turn out to be something of a higher magnitude than that. And they've each got very distinct downside targets and some intermediate cycle lows coming in over the next several weeks, when you could see the specific lows in different indexes. But by and large, I'm had been and continue to look for the same scenario of a sharp decline from February 11th, 12th into March 11th to the 13th. The S&P 500 gave a very clear sell signal on the February 25th close. I had detailed right where to enter those short positions to my subscribers in the days leading up to that, and then it was triggered right as we were rallying into the close on February 25th. That turned out to be the peak of that bounce, and they've all headed lower since then. So all of these indexes are adhering to that outlook and those cycle progressions, and we still have the potential for some additional spike lows since we are still in that March 11th to 13th, maybe even stretching into the 16th time frame.
The U.S. dollar put on a bottom late January and has been moving higher since. What do your cycles see ahead for the greenback?
I think that the dollar index is as you point out, in a bouncing phase, a rebound, but I don't think that is going to turn into anything much more significant than what we've seen up to this point. My work in the dollar index is still that it will progressively move lower into next year. And the ideal scenario from several different cycle progression standpoints and perspectives was that we see a secondary peak this month in March of 2026, because that is the midpoint of a couple of those cycle progressions that I've illustrated and detailed. And if we do see a peak now and we see a reversal before the end of the month, reversal back down, that would powerfully corroborate the overall outlook and some future cycles that I think could be spelling more trouble for the dollar index out in the second half of 2026 and even into 2027.
The Canadian dollar looks to be showing some strength. Where is the Canuck buck in its cycle?
It has been going through a bottoming phase and turning higher, and I still think it has more upside to it. I'm looking particularly up around the 76 level, and I look more at the futures, but that's pretty close to the cash too. But my work is showing that we could see a move up to there in the coming weeks or 1 to 2 months. And I think it's more in this long-term bottoming phase that could be positive looking out over the next 3 to 6 months or longer.
Bitcoin continues to trade in a range between $65,000 to $70,000. When Bitcoin breaks, do you think it'll be to the upside or downside?
I still believe that Bitcoin has another low in this whole sequence. In late October, I detailed the series of downside targets and timing frames that I had for Bitcoin, because everything was saying that it should peak, it should retest its July peak in October, and then that would be a final top in Bitcoin and cryptos. I have several special reports that I put out before that and right after that saying the same thing and detailing where we should go in the what I expected to be at least 3 successive declines. We've now seen 2 of them. The first 2 bottomed at their prospective targets, and the most recent one was expected to bottom before mid-February, and if it did, which it did, that would corroborate more significant and higher magnitude cycle progressions that converge in late April through mid-May, which is when I think we will see a final spike down in this overall wave structure from the October peak. And I've detailed a couple of downside targets we could still see and some specific levels that Bitcoin needs to remain below in order to validate that analysis and reinforce the downside projections.
Light crude oil spiked to just under $120 US per barrel on Sunday, then plunged in price. What's your oil cycle looking at?
Still the same thing that I've said the last few months, that January was a convergence of multiple crude, heating oil, cycle progressions. Actually, they were very distinct from each other, which to me that gives a little higher level of credibility because it's not just all of them kind of saying the same thing. But heating oil had a very consistent 5-month and 8-month cycle progression. Crude oil had a little bit longer term cycle progression all coming into play in January. And that's why I kept publishing at that time why I thought crude, heating oil, ultimately natural gas, and many of your related commodity indexes that are heavily weighted in energy, like the Goldman Sachs Commodity Index, would see big surges during the first quarter of 2026. And that is certainly what we have seen. I thought that the energy markets would see this initial surge into March 13th or 16th, Friday, tomorrow, or next Monday. And that still is the case. We're on track to probably set the highest daily close today, and then Friday's close could do the same thing. That would certainly fulfill these timing objectives. But that doesn't mean that it's the end of the overall uptrend, but it would certainly be a point where we could see some consolidation a little bit below the highs.
Natural gas has moved higher off February lows, whereas natural gas in its cycle.
Natural gas has a little bit different interval or periodicity to it, different rhythm that it moves on for obvious reasons. And it had a very consistent 7 to 8 week cycle progression that timed the early December highs and then late January highs. And combined with a few other timing factors, I have thought that the very end of March would be when we see the next peak in natural gas. So I have been looking for it to build a base above its late February low. My work gave some buy signals in late February. I was also looking at the UNG ETF, which was creating some very interesting technical patterns, and I expected it to hold right around 1150, which is where, at the same time, the June natural gas was trading around 305, spiked down to 3. That's where the buy signal was triggered. And so I just need to see a couple of confirming closes in the next couple days. Really, the March 13th weekly close will be a key factor in that analysis. And that is what I would increase my confidence in that outlook for an overall rally into the final days of March. But I do see some additional future highs when some longer-term cycle progressions come into play in the second quarter of this year.
Are agricultural cycles likely disrupted by the war with Iran?
They have certainly been magnified. One of the key grains that I was really watching through the last couple months was wheat as it was forming a bottoming phase. And it went through a whole series of indicator reversals that I describe and illustrate to my readers, and then showed that it should see a big surge into the first half of March. It has set very consistent highs on an 18 to 19 week cycle multiple times. And that cycle really was focused on the current week, March 9th to the 13th, as the more likely time for a spike high. And so wheat and soybeans and corn have been fulfilling that. Again, very magnified by the events in the Middle East and fears about shipping and everything related to that. But I could see a interim peak take hold here. So that kind of fits with all of this analysis that has been focusing on these days surrounding March 11th to the 13th. So we could see a pullback in those grain markets if things top out in oil and bottom out in stock indexes and go through a little bit of a consolidative phase in the next week or two.
LIT, the lithium ETF, just had a short pullback. Is the LIT behaving as expected?
Well, what I keep saying, I know we've discussed this for 6 or 8 months now, is that the LIT ETF trades like the stock market. In fact, the price of lithium is only a minor nuisance to its movement, and that ETF topped along with stock index cycles in late January, then a spike high in late February, and rather than just viewing the recent sell-off as a pullback, my work is showing that it's a little more likely to be the first sell-off of a larger corrective phase, but there are a couple of confirming closes I need to see before that will be a very strong conviction on my part. But it's trading very much like stock indexes and a little bit in sync with the price of lithium, but much more in sync with overall equities. And so I continue to expect it to move similar to that, but the real key is if it can get a daily and eventually a weekly close below 68, that would be the real confirmation that a multi-month top is taking hold.
Are any of your cycles predicting a sell in May and go away?
Not at this point. In fact, a lot of these indicators that I use were telling me to sell in late February and sell in late January. But I think we could see some important lows take hold before May, and what I expect moving forward from there would sometimes be in sync with that mentality and sometimes be contrasting that mentality. So just a general sell in May and go away adage or scenario I would not be looking at. I think there are some more specific and more precise levels for both the selling and buying in the coming months.
Where can listeners subscribe to Inside Track, spelled with 2 I's?
They can go to our primary website at InsideTrackTrading.com, and like you mentioned, that is inside spelled with 2 I's, so it is INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Our conversation took place on March 12th. Coming up, Hilliard MacBeth next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He's speaking to us from Edmonton. Welcome back to This Week in Money.
It's great to be on your show again.
Where can our listeners get your book?
They can get it at any of the top bookstores, and also more and more people are buying the ebook version on Kindle or Kobo or any of those electronic book offerings.
What's the big message in the book? I guess, it's in the title, but...
Yeah, well, I think the second edition came out in 2018, and it was about the coming bursting of the bubble. The bubble had been forming for years, and the big component of the bubble that people generally don't talk about as much as they could is the debt that's associated with it. And the message of the book is how to survive the coming crash in Canadian residential real estate that is going to be precipitated and made much worse by the inability to repay the debt. So we're right in the middle of that right now. So it's very timely. Nothing that I wrote in the second edition 7 years ago everything is timely with what's happening right now, because we are right in the middle of it. This is the bursting. One of the conceptions that's hard for people to grasp is how long it takes. So in Japan, it was basically 25 years and perhaps still counting to unwind that bubble. And this bubble in Canada was of similar proportions. The Japanese one peaked in 1989. Ours peaked somewhere around 2017 to 2021, depending on where you want to measure it from.
Are the ongoing attacks against terrorist locations in the Middle East, especially in Iran, are likely to cause ongoing volatility in the markets?
Yes, absolutely. The unusual feature of this particular war that the U.S., I think, kind of stumbled into without much planning or forethought is the impact it's having on the oil market. So they bombed in 2025 for 12 days, and people were worried that it might impact the market, but it didn't really have much impact at all. And I think maybe that's why the U.S. was complacent going into this one. So one of the reasons they were complacent going into this one. This one now is different because the Iranians, I don't think anybody realized, at least not in the White House, that they could block the Strait of Hormuz so easily. And 20% of all the oil produced in the world, consumed in the world, 100 million barrels a day total, 20 million of it goes through the Strait of Hormuz. So there's no way to avoid some pretty wild consequences if the Iranians decide to keep that strait closed for a month or two.
Yeah, and the strait is incredibly narrow, although officially it's 21 miles. The shipping lane itself is only 2 miles or 3 kilometers wide.
Yes, and that's why it's, I don't think people realize how easy it is for the Iranians to block it. They don't need to have like ICBMs or sophisticated missiles or something. They're using things as simple as just limpet mines, which can be attached to the side of a ship. And it's done by, divers. They don't have to be even Navy SEAL divers. They could just be regular divers. And it's extremely hard to combat against that because it's done in nighttime. And there's other kinds of mines as well. There's ones that are attached to the bottom of the channel, and there's ones that are floating on the top, and there's ones that are, there's just so many different ones. And the Iranians have been, this is not new to them, so they know what they're doing. And you don't have to take the tanker out. You just have to cause enough damage to it that everybody freaks out, and then the rest of the tankers won't go through anymore, which is where we're at right now.
Sunday, oil spiked to a high just under $120 US a barrel. Then it pulled back. Since the pullback, oil has been moving higher again. In a news conference on Monday, President Trump says we're going to see lower oil and gas prices. Do you think Middle East stability could make this happen?
I think that the experience with Venezuela, when it was it was over very quickly. They went in, they captured the head of the government. They used a very small team. There was some support, obviously. There was almost no opposition. I think they killed less than 100 people to get it done. I think that gave them a sense of overconfidence, and I think that's where that comment from the president comes that oil will be back down to a lower level again. But I think what he was underestimating, so as we're speaking here on Friday, the oil has ticked back up to where it's close to $100 a barrel. And it's entirely to do with that 20%. That's the key number. 20% of all the oil goes through the Strait of Hormuz. And as long as the Iranian forces are able to block that, the oil price can't go down. Now, eventually it will go down. There's been spikes in oil before almost all of the recessions we've had since the 60s. There's been a spike in the price of oil and then a drop in the price of oil. And the drop in the price of oil comes when the recession gets bad. And that's because the demand for oil drops quite quickly during a recession. A lot of oil consumption in the U.S. especially goes into cars and trucks and is for transport, and that can be shut down fairly quickly. Not shut down entirely, obviously, but it changes quite rapidly. So we have a big spike in the price of oil. We had it in 1999, 2000. We had it in the 70s. We had it in 2007. Went over $100 a barrel. And then we're followed by either a financial crisis or a recession or a bear market in stocks, or all three at once in the case of 2007. And it can even be somewhat unrelated to the war, but in this case, the war is the catalyst. And the likelihood that this war will be over as soon as President Trump would like is quite low, because the Iranians know that Trump's party faces Trump won't be on the ballot in November, but all of the members of the House of Representatives, all 464 of them, are on the ballot, and about a third of the senators are on the ballot, and they're getting increasingly scared that this is going to wipe them out in November, and that's something the Iranians want to think. They're thinking about that, and they're thinking, if we can drag this out for a couple of months or 3 months, then you're into the summer, and then you're really starting to hurt the U.S. president, and you know they're looking for revenge. There's no question about that.
Could lower oil and gas prices be concerning for Alberta?
Well, yeah, I remember. So I think it was at the 2020 spike, and then the oil price went down and it became negative for a while. I don't know if you remember that. The price of oil went to a minus number. That is entirely based on the futures market, right? It's not actually a real price, that anybody can't pay a negative price for oil that easily, other than in the futures market. But for sure, I mean, we had the budget in Alberta, where I live, a couple of weeks ago, and it was a $9 billion deficit, and that was when oil was $65 a barrel. So now oil spiked up 50%, up to roughly $100 a barrel, and but it could easily go back down to $60, $70, and that would put the Alberta government back in deficit again. Now, the energy minister and the cabinet in the U.S. Yesterday, so that was Thursday, was talking, and he said that the U.S. is self-sufficient in oil, and it doesn't need any oil from the Middle East. And he was talking in such a way that he doesn't seem to be aware that Alberta sends 4 million barrels a day to the U.S. The U.S. is self-sufficient in oil with the 4 million barrels a day from Canada. So the total they consume is about 20, and they produce themselves about 13, and then about 65% of the difference comes from Alberta. So they're self-sufficient, and maybe they've already in their minds considered Alberta to be part of the U.S. I don't know. But at any rate, they also export oil, but that's because the oil that comes from Alberta is the kind that the refineries are hungry for, and the oil that they've discovered in Texas, West Texas primarily, and the shale oil, is a different type of oil. It's a very light, sweet oil, and the refineries aren't set up to handle it. So they export a lot of that light oil, and they use the heavier bitumen type oil in their refineries. That's the kind of oil they're set up to take. So it's a complicated thing, but and there's no reason actually for the U.S. to pay these $100 a barrel prices, but they're committed to the free market setting the price. So that is what will happen. But they could basically block off those exports and force a price onto the market that would be quite a bit lower than 100, but they're not going to do that, I don't think.
President Trump has been instituting tariffs with a plan to eliminate income tax. Is that likely to make the people of the U.S. more or less prosperous?
So that's an interesting question, because what happens with tariffs is, of course, although the administration won't admit it, the consumer pays the tariff one way or another. The shipper from, say, China would be an example, or from Canada, might drop their price a little bit, but generally the tariff is applied when the goods come into the U.S. and the money's sent off to the government, and then that price is passed on to the consumer. So if you replace the income tax with tariffs, what you're doing is shifting the burden of taxation onto the average person, where consumption is a big part of their daily life as a percentage of their income, and shifting the burden away from the higher income. So the higher income people paid the bulk of the income tax because of the progressive income tax issue, and they also have the income. So Trump has promised the wealthier segment, the 1%, that they will have lower income taxes. He's delivering on that, and now he's promising even more to lower the taxes even more, and it'll generally benefit the higher income people and hurt the lower income people. So it does hurt people in a way, and it also helps people, but there's a different in different segments of society. The tariffs have not, the big experiment with tariffs was in 1900 to 1905 or something, and the president, his name I can't recall, Trump keeps talking about this guy. He abandoned it after a while because it didn't work. It seemed to be working for a while, and then it didn't work. And then, of course, in the 30s, most people are familiar with the Smolley tariffs. They were interested, and they were a disaster, and everybody knows they were a disaster. They deepened the recession and made things worse. So this is the third big attempt, and it hasn't shown up in the economy as much. I mean, the U.S. economy, there were some signs last week that job growth is basically zero over the last 12 months, but the economy seems to be still hanging in there pretty well. The unemployment rate is only 4.6%, much lower than Canada. And so it hasn't really shown up in a really obvious way yet. But most people that are knowledgeable about these things say that it can't be helping the economy very much.
In times of turmoil, are the U.S. stock markets and the U.S. dollar still considered safe havens, or could other countries become the new go-to safe havens?
Well, that's a great question. And every crisis, so I've been doing this since the 70s, and every crisis, the U.S. dollar and U.S. securities, especially U.S. Treasury bills, have turned out to be the safe haven, even when the U.S. creates the crisis, which has been the case fairly often, like in 2007. That subprime mortgage thing was entirely U.S. created. But the U.S., especially not so much the long-term bonds. The long-term bonds can get hit pretty hard because of the uncertainty, but the short-term U.S. securities, government securities, have been the safe haven. Now, most of the benefit of being in those securities is because of the currency. It's not, you don't get a big profit off of trading treasury bills. They don't change price very much, even if there's a big change in the interest rates. So it's got to be the currency. So now the serious questions are being asked if the U.S. is going to be the same. First of all, they've got a huge government deficit, so that's not a safe haven type situation usually. Secondly, they don't seem to have the dominance in the world, militarily or otherwise, that they had 20 years ago, 30 years ago. It's been slipping. And thirdly, we don't know if the currency is going to be as strong as it used to be. It used to be that the currency always was quite strong. So the alternatives, though, are difficult. So the main alternatives, of course, are the Asian securities. The Chinese renminbi is the problem there is it's not fully tradable. It's not free floating. It's a managed currency. And then some of the smaller ones are scary. Vietnam, Thailand. The Thai baht especially is quite volatile. And I'm not enough of an expert in those currencies. The Korean currency. to be able to help very much. But that would be where you'd expect the safe haven, whatever it turns out to be. If the U.S. dollar is replaced, it would be probably in one of those securities. The other one is obviously the euro, but the euro has problems because it's not one country, and the big benefit of the U.S. was when that crisis in 2007, 2008, 2009 hit. There's one, they'd say there's the Fed, there's these different Fed banks, and there's the big Federal Reserve and all that, but it's not really true. That's more of a political thing. The New York City Fed, the New York Fed, at the time there was a guy named Tim Geithner who was the head of the New York Fed, and the chair of the Fed at the time was Alan Greenspan, I think, or Ben Bernanke. That's all they needed. They just need those two guys, and Goldman Sachs and Morgan Stanley and a few people at Wall Street. They all get together and they sit down and say, "Okay, we gotta save this. We gotta do something to stop the market from dropping and end the crisis." And they did it. And they did it they had to involve the Secretary of the Treasury as well. But that's just a few people, and they were able to do it in a matter of a few days or a week or two. The euro does not have that. They cannot. There is a European central bank, but then each of the countries has their own central bank. The most important one being Germany, and they have to. It takes them weeks and months and years to come to an agreement on what to do, and of course by then it's way too late. So the euro, in theory, would be the one, but in practice it doesn't work. So the ones that would work better as a safe haven would be probably eventually be the Asian securities. But for now, I think probably most traders and investors are going to still think of the U.S. dollar as being the safe haven.
The Musqueam Indian Band did a backroom deal with Prime Minister Mark Carney to gain property title to most of Greater Vancouver. Due to land title uncertainty, are banks likely to halt new mortgages and mortgage renewals in the affected area?
I don't know if that one will affect the mortgage issuance that much. It could, but the bigger issue is the loss of value in these in the Vancouver area and in the Toronto area, but especially in Vancouver. There's several developers. Just this week, there were 2 or 3 announced that have been unable to sell their. Some of these developments are fully finished, and they're just not getting the buyers, or the buyers that put down the deposit 2 or 3 years ago are unable to close on the property. So they basically, some of them are able to return their deposits, and some of them are probably going to have to go through some kind of receivership or bankruptcy, and that's the bigger problem, because when you get the lifeblood of this whole thing, especially in Canada where real estate is such a big part of the economy, you have to have those new mortgages going out constantly to replace the ones that are being paid off. Everybody has a mortgage, is paying off the mortgage every month in a small amount, but cumulatively it adds up to billions and trillions of dollars. And so you need constantly to have new mortgage money going out, or else the economy starts to shrink, and then you've got a really severe recession on your hands. So we're in this unfortunate position where we've got so much real estate debt out there that if there's any doubt about the collateral in the case of these land claims, or if there's any doubt in the collateral in the sense of just people can't afford to buy them, or the buyers just aren't there, or the developer goes bankrupt or something, then how are you going to put that mortgage money out? And it's very difficult to convince people to take out a mortgage if prices are dropping. And of course, the banks have rules that stop them from, at least in theory anyway, stop them from putting mortgage money out if the collateral is shrinking in value. One of the scandals that came out this week, but it's been around forever since I started writing that first book more than 10 years ago, is the blanket appraisal. So the banks had this system, and I forget the name of it. It's an electronic computer system. They would just plug the address into that system, and if the computer said it was in an area that was okay to lend to, the mortgage agent could say, yes, okay, you're approved for that mortgage. And so they didn't even do a drive-by assessment or any kind of, they didn't have people go and look at the house to see if the house actually exists, if it's actually on the lot that says it is. And so that's that kind of thing in a declining value market and the bursting of a bubble that we're in now. That's the kind of thing that gets reversed. They say, oh, no, we can't have that anymore. We have to stop doing that blanket appraisal thing. We'll have to start appraising properties one by one like we used to do before the bubble formed. And that slows everything down. So you got a real problem with mortgage issuance, which is, as I mentioned, the lifeblood of the economy to a large degree.
In a recent interview, Sam Cooper, the author of Willful Blindness, said that between Vancouver and Toronto real estate markets over the past 10 years, $1 trillion has been laundered. That's $100 billion per year. Sam also mentioned a high U.S. contact told him it's more like $200 billion per year. There's now a major crackdown on drugs and crime in the U.S. If this consistent laundering of money dries up in Canada, could real estate markets be affected?
Oh, for sure. This is. I didn't put this in my book because I didn't at the time that I wrote it. It was happening, but I didn't know enough about it, and it was like a whole separate book essentially. And Sam Cooper, I met with him and we talked, but he was writing a book. I think it came out. It's called Willful Blindness.
Yes,
and so. Absolutely. There've been two studies in Vancouver, and they confirmed those kind of numbers. And the $1 billion sounds like a lot of money, but if the houses are $10 million each, it doesn't take a lot of houses to get to $1 billion. It's 100 houses, and so I think that's right. In West Van alone, there was a turnover of probably that many houses, maybe not all at the $10 million level, but they were all between $3 million and $10 million or more every year. So now the money isn't necessarily all new money that's being laundered; it's being re-laundered, if you like, because one of the phases of money laundering is the obfuscation of the source of the money. So you place the money in the first instance from China or wherever it comes in, but it's traceable still. But once you sell that property that you buy with that first batch, and then buy another property, and so on, then it becomes much harder to trace. So there's a lot of activity that goes on. There's new money coming in all the time. At least there was up until recently, and so it's a huge part of them. And it's really unfortunate for the people that live in Vancouver because and Toronto for that matter. There's some even in Calgary and Edmonton too, not as much, but because those people that are buying that $10 million property in West Van, they don't care if they're paying like $2 or $3 million more than they should be. Maybe the thing's only worth $6 million, but they pay 10. Their problem is to get the money laundered, not to worry about losing money on the sale. So they'll buy it for $10 million, they'll sell it, turn around and sell it a year later for $8 million. But the neat thing about that is now the $8 million is clean and it's done. So, depending on the source of the money, if they didn't work that hard to get it because it's got a kind of a dark and obscure source, whether it be drug trafficking or stealing from the government or whatever, then they're happy to have the $8 million and they don't care. Yeah, there was a big development in Toronto a few years ago, high end properties in these condos. And condos are ideal for this because you can buy like 10 condos at once. Some people would buy 20 condos in a building. They did, somebody, I think the Toronto Star or somebody like that did a study that, 5 or 10 years later. And most of the ones that had sold have been sold at a loss. And everybody thought, oh, that's terrible. They don't care if they sell at a loss. Now they've got that money and they can put it in. Now it can be deposited in a bank and the bank doesn't need to worry about the source of the money and life is good. So that was the trick with those. There was a Trump Tower in Toronto and a Trump Tower in Vancouver, both of them. Neither of them is a Trump Tower any longer, but in the initial stage of it, the idea was to get money in from Russia or wherever, get it laundered, and then press on and make. And the people that provide the condos make a very nice profit, because the money launderers are not that fussy about how much commission is charged or what the markup is. They just want the money to flow quickly.
What's the latest on the real estate downturn in the various Canadian markets?
Well, it varies from market to market. In Alberta, we actually don't have as big a drop as they do in Vancouver and Toronto, partly because we had people moving here up until recently, and a lot of the immigrants that were coming in, who are no longer coming in, by the way, but they were coming into Toronto, but then they would fairly quickly decide to move on and move from Ontario to Alberta. And our premier's been complaining about all these new people that have come into Alberta Alberta's was 5 million people or whatever. Now it's 6 million. It puts a strain on everything, but it also pushes real estate prices up. But in Toronto, Vancouver, the supply of money coming from money laundering has really stopped. The flood that was coming in, that Sam Cooper referred to, is now a trickle, and it's a big change. And so the prices of these properties are dropping. The other thing that's happening is that the decision to build these big high-rise condos was made 5 or 6 or 7 or 8 years ago, and deposits were taken, but now they're actually hitting the market. And so prices in 2021 are, in some cases, as much as 30 or 40% higher today, or 30%, 40% higher when a deposit was put down, and today they're lower. And one of the things about those projects, the way they sold them, was they built in a price increase. So if the current market for a condo in 2020 or 2021 was $1 million for less than 1,000 square feet, they assumed that it was going to be $1.2 million or $1.3 million, and that's what the price was set at for the contract. And the person was only putting down $50,000, so they weren't that fussy about noticing that, and they believed that it would go up that much. But it's actually gone the other way. So now you're looking at a contract that's written at $1.2 million, and the property has declined from $1 million, peaked down to $800,000. So it's just too big a gap to handle. So that's the overhang. But it's happening in single family. It's happening in, there are pockets of strength, but generally the bursting of the bubble is gaining momentum. The prices are dropping. There's very few sales, which tells you that the buyers are reluctant, even with the lower prices. They still think the prices are going even lower. And the sellers, of course, are always slow to recognize that prices have dropped. So what happens is that the first place you'll see it is in the new homes, where builders go broke, and then the bank takes over, or the lender takes over. And in the case of new homes, a lot of times it's not the banks; it's one of these private lenders, and they just dump the properties on the market to get at least some of their money back. And then, of course, if you got a brand new home that's selling for less than an existing home, that puts a lot of pressure on the existing home stock, and away you go. The people that are in their homes, they've owned them for a long time, they're more likely, if they can handle it, to take the property off the market and just decide to stay there longer rather than accept a big loss. But when they eventually do pass on, and the beneficiaries of their estate inherit the home, they tend to be more like, let's just get rid of it for whatever we can get for it, kind of thing, because they want to get it resolved. Let's get this estate resolved and divide up the money. So it's a slow process. That's why these bursting of these bubbles takes years and years rather than months and months. It takes a long time, and people are reluctant to. They have an anchor price in mind, a peak price in 2022 or 2020 or whenever it was. And they say, my house is nicer than that one that sold down the street, and I deserve to at least get that much. And they kind of get stubborn, and but eventually either they or somebody else on their behalf makes a decision for them.
Is this the beginning of the crash predicted in your book, When the Bubble Bursts?
It is. I think the definition of crash. So the definition of crash in like if you think about Tokyo or Japan in 1989, or think about the U.S. in 2000, actually, the financial crisis actually hit at probably the worst of the financial crisis between September 2008 and March 2009. But the real estate market actually peaked in 2006 or 2007, and it kept going down until 2010. So it was 4 or 5 years, and then it took another 5 years or 10 years to actually get back to prices. So it was a 10 to 15 year process. So on that time scale, so I mentioned Japan was 25 years. Let's say U.S. was 15 years to get back to even. We're still in the early stages. We haven't even hit bottom, and I don't know how far down it'll go. But I don't. My feeling is, my gut feeling is, we haven't reached the maximum drop yet. Some suburbs in Toronto are down 30, 35%, but I think you're going to see 40, 45, 50% from the peak levels. Whether those levels are 2017 numbers or whether they're 2021 numbers, somewhere in there. But let's take the 2021 peak. So it was the end of 2021. So let's say we're at less than 5 years or 4.5 years from that peak. We should see in the next, if there's a recession in Canada, because we haven't had a recession, right? They flooded the market with so much money because of COVID. We never actually saw the recession that we probably were going to get otherwise if COVID hadn't happened. So in that, we need to have that recession to find out what the actual correct prices for these properties are. But at the last stage of the drop, it can go quite quickly. And you'll never know the price of everything because not everything sells at the bottom. Unlike the stock market where, that's listed in the stock tables. The housing thing is much more obscure. But we could see in some point in 2026 or 2027, kind of a washout, a surge in power of sale or foreclosures, and some ridiculous prices being established with sales that are forced at that point. And then you start the long, slow climb. And as I mentioned, the climb can take 5, or in the case of Japan, 10 years or longer.
Do you see any bright lights in the Canadian economy?
I think the one bright light, and you and I may have talked about this last time, is these data centers that are being built and the electrification of the economy. So in our stock portfolio, we bought some companies that are in the business of electrifying the economy. Back when we thought that all the cars are going to go electric and all the solar and wind and all that kind of stuff, and then that was sort of went kind of sideways when Trump was reelected. But actually, in spite of Trump, who's totally against all that, the electrification movement is still moving ahead. And one of the reasons is solar, wind, and electric cars have all become so cheap that it just makes sense to make the move. But then on top of that, the data center thing, the AI thing came in, and they're going to have to upgrade the grid to handle the power sources for both the data centers and for the electric cars and trucks. So all of those things, they use basic materials like copper and nickel and iron ore and cement and all that kind of stuff. They can't build these things, and these things are huge, expensive builds without tapping into all of those basic materials. And Canada has an abundant supply of basic materials. So that's one thing. But the other thing that's happened because of the uncertainty may be related to what we talked about at the beginning of this call, which was the safe haven of the U.S. dollar. Gold is doing extremely well, and Canadian mining stocks and the gold mining are extremely positive. Now, it's not a big enough sector have that big an impact on the stock market, but it can have a big impact on people's portfolios. And for example, the S&P 500, obviously, there's about 500 stocks in that U.S. index. There's only one gold stock, Newmont Mining. So it's like hard to. It's not going to move the number. In Canada, there's more than just one, but it's still a very low percentage of the total. So that's been around for a while. It was chugging along really nicely, and then this attempt to dismantle the moves that were made towards electrification by the new administration that came in a year and 3 months ago, kind of slowed that down a bit, but it never actually stopped. It just slowed down a tad. So that's the area. And copper's the lead. There's a lot of copper goes into electrification. There's no real way to get around it. But there isn't much in the tech sector in Canada. There's a couple of stocks, but not really a lot. And as far as the economy in general is, well, Canada spent very little on defense, as President Trump complained on several occasions. Correctly, Canada was one of the lowest in the NATO and in the developed countries. And originally they were talking 2%, and now they're talking 5%. Well, Canada was under 1.5%. So under Trudeau, they agreed to move it up to 2%. Now under Carney, over several years. Now under Carney, they're talking about doing more and doing it faster. So they recently announced, for example, $35 billion going into the north, and that's for sort of quasi-military type defense installations. So that's going to be a big positive for the economy. Unfortunately, we don't have a lot of companies in Canada that make defense type equipment. It's mostly American companies, and there are a couple of European companies that are interesting. But it'll have a big impact on. So when they buy these defense, they make these big defense contracts. They usually negotiate that some of the jobs come to Canada, so that would be a good thing. But there hasn't been a lot of job growth. I don't know the numbers for Canada off the top of my head, but I was surprised when the U.S. numbers came out last week. They had a very poor. I think it was last week or 2 weeks ago. They had a very poor job growth number. And if you dug a little deeper into the numbers, it was even worse because all of the growth was in the what you call the helping healthcare and helping people that need elderly people that need help and retirement homes and stuff like that. None of the other industries had any growth at all. So basically, you're in a zero growth from an employment point of view situation in the U.S. and Canada isn't a whole lot different. The numbers came out today on Friday as we speak, and the economy was weak and the unemployment rate jumped up to 6.7% overall. So there's not a lot of bright spots in the economy apart from that basic materials thing. And if we could figure out how to bring mines on faster, because they take way too long to get a mine approved and then built, that could be a huge boost to the economy. And I think there's been some talk about expedited approvals and that sort of thing. So that would be helpful.
Sounds like some EVs could get solid-state batteries as soon as 2027 or 28. Do you think solid-state batteries could attract more and more people to buy electric vehicles?
Well, I think people are buying the numbers everywhere except North America. Canada and the U.S. are very unusual in the lack of buying of electric vehicles. But everywhere else, Europe, Africa, South America, China, of course, we're getting up to numbers like 25, 30%. In China, it's 50% of all the new cars bought are electric. So it's happening, and they're not waiting for solid-state batteries. The latest, so the biggest company now in the world is surpassed Tesla is BYD, which is a Chinese company. And they were producing both gasoline and hybrid and battery electric, but now it's shifting more and more to battery electric. because they can build, believe it or not, this probably wouldn't sell in North America, but in Latin America and other places, they're selling these basic electric vehicles for under $10,000 US. Well, let's just imagine how well that would sell in Canada if we could get them in here. In both Canada and the US, there's 100% tariffs, but Canada's talking about reducing the tariff in the next couple of months down to a much lower number if certain conditions are met. And BYD is talking about building a plant in Canada, so that would be one of the conditions that would get that tariff removed. And their vehicles. I mean, I haven't personally driven a BYD, but I've been told by people that I trust that know a lot about these things to say these are perfectly acceptable cars. And as you and I talked before, my wife got a Tesla in 2024 that was built in the Tesla Shanghai plant. And it's way better than the one I have, which is built in the California Tesla plant. So I don't think we have to worry about quality. So I think that's going to be a big, and you know, it's impossible, I think, for Canada to get in on the boom, the big move towards electric vehicles to boost our economy to any great degree, because we're not going to be allowed to build electric vehicles in Canada, sell them into the U.S. like we've been doing with Detroit and Windsor for all these years. So we would just build maybe we could build it for our own use and maybe some exports to other countries, but it's not going to be that big a deal from that point of view. But certainly it would be a big deal from the point of view of reducing dependency on fossil fuels and getting better cars for cheaper, which is obviously good for everybody.
If you could buy any new electric vehicle today without cost entering into the decision, what would you buy?
Well, you know, the one that I own, the Model S Tesla, they've discontinued that. So I can't buy the next one. Can't be a Model S unless I buy I think the last ones were built in early 2026, and they're not building them anymore. So, but I would look seriously at the ones that are coming out of China, because they've got some that are, you know, the thing that attracted me to the Model S that I have is the acceleration, the range, and the speed, and all that stuff. Well, some of the new ones that are coming out of China are even faster, and they have better range, and the batteries. This is the thing I didn't mention, but I'd like to add when you asked about solid state batteries is BYD and another company called CATL. They have got batteries now that can charge fully in less than 20 minutes, and they can in 5 minutes they can get substantial boost to the range. So this is the game changer, because what that means is and this they've tested it in cold weather down to -30, and it still works, which is shocking, because that's the one thing that isn't great about my car in the Canadian thing is in the cold weather, my 600 kilometer range drops down to 300 kilometers if it's cold, really not like if it's -30 or -40. So if they can solve that problem with regular batteries, we may not need to wait for the solid state batteries, because the solid state batteries have some really big advantages. But the one disadvantage of them is that they're much more expensive. So the CATL and BYD offerings are coming with much faster. Now you need to have different chargers. You can't just plug it into like a current Tesla charger and get those results. You have to have a special charger to be able to do that. But that'll change everything, because one of the things, and I've been watching this and nobody's mentioned it yet. So I think, because I don't think people have thought this through, that if you have those kind of ranges and that kind of speed of 5-10 minutes refill, you can have a smaller battery. Like most people don't need. I've got 600 kilometer range on my car. I only use that maybe 3 or 4 times a year when I'm going to Vancouver or going long distance or up into the mountains or something. Most of the time, I don't need that at all. You know, I'd be fine with 300 or 250 range or whatever. You know, so if you had a smaller battery in the car, it gets cheaper, it gets lighter, it's way less weight. The battery is the most expensive part of the car, so it obviously is going to be cheaper if it's a smaller battery. So it's going to accelerate this whole thing. And then if you want to have a high performance car, you can do that as well, because you can put that much more charge in a smaller space and less weight. So I think solid batteries are coming, but if they take too long, these current batteries might actually these changes that are being made might miss out.
Are you going to get in line to buy some of Elon's robots?
No, I don't think so. I not the current ones anyway. I look at these robots that are standing like a human on 2 feet, and it doesn't make any sense to me. Like, why would you, like, that's a very unstable base to run around. And like, if humans were on 4 feet instead of 2 feet, they would be much more stable. Like, we got winter in Edmonton. I'm walking the dog, and I'm worried about slipping and falling. The dog's got 4 feet. If one of his paws slips out, he's still got 3 feet. He doesn't fall down. I mean, occasionally he falls down, but he's much closer to the ground anyway. So I'm waiting for the robots that are more compact and maybe more useful. I think these Optimus ones that stand at 2 feet, I think that's more of a marketing gimmick than an actual real robot thing. But I would also, unfortunately, you keep going back to China. But we have to talk about China when it comes to robots. I'd be wondering if there isn't a Chinese offering that's maybe better than Elon Musk's offering. By the way, and maybe we could talk about this next time. Elon Musk is trying to take SpaceX public, and he's demanding from the NASDAQ stock exchange some changes to their rules about when it can be listed and how it can be listed. And that's what he's talking about a 1.5 trillion or 1.75 trillion market cap on a stock, which would include SpaceX and Twitter or X, and then XAI, the AI portion. But most of the value is in SpaceX, and most of the value in SpaceX is actually in Starlink, the communications network. He's got thousands of satellites in the sky now that give you internet and voice calls and everything at a very cheap, high-speed rate. So he's trying to get that done by June. And in order to get it done, he's asking the NASDAQ to change their rules. And it's just happening now. So I don't have the full story yet, but it's actually quite interesting. But it'll affect the stock market, because once that thing is so big, it's like Apple's and NVIDIA are bigger, but it's in that lower end of that range. It'll affect the stock market because of the way there's so many ETFs now. They call it passive investing, that they have to buy SpaceX. If it comes out of the market and it's included in the index, then they have to buy it. And he's talking about issuing. These numbers are incredible. He's talking about 1.75 trillion, and he's talking about only having 50 billion in the float. And so a tiny amount of stock will be let out onto the market. The rest of it all will be still in the company. And yet all these people are scrambling because they have to buy SpaceX to represent their portfolio in the ETF or in their if they're trying to beat the benchmark or whatever. Once it's listed in the NASDAQ, then they have to buy it. They don't have a choice. So you could see that thing skyrocket to a ridiculous. It's already being priced at a ridiculously high price at 1.75 trillion. But you can see it skyrocket and even double to that because of this. There's only 50 billion available to buy in the market in the initial stages.
Where can people follow you, and where can they buy your book?
So I'm not as active as I was, but I'm still on X, and I post stuff, and especially on Fridays, I post my weekend note. This weekend it's about the war in Iran and 20% of the oil that goes through the Strait of Hormuz, and it's great if people could latch onto that. And then there's a link you can go to the website and sign up for a free following to get those sent out by email. And as we mentioned, you can buy books anywhere in the system that you can buy books. They'll be able to have it. If they don't have it in stock, they'll be bringing it in. They can order it for you.
Thank you so much for being on This Week in Money.
Nice to be on the show.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.Partners.com. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.